Okay, I've just switched on the live feed. It's 8 o'clock. No one's ever on time for these things, but I'm an engineer, so I'm kind of phobic with being late for things. So I thought I'd switch the feed on anyway. I'll give people a minute or two to arrive. Like I said, it's the 12th of June. It's 8 p.m. in the evening. So this is a live stream on LinkedIn only this evening. So if you are watching this and it happens to be 8 p.m. on the 12th of June, then you're joining me live. So thank you for doing so. It's a strange format, this LinkedIn Live. It's a streaming service with software that you use, and so it tends to be a bit one-way traffic, really, not so much like a webinar as more of a stream. So I can see comments. If you put comments on the event itself, then I can see those here. So there's that facility. But apart from that, it's more about me presenting some information, some ideas. You tend to get people coming and going, but it's a repository thereafter for this information, from me putting my thoughts down, and I'll put it on YouTube at some point in the future as well. So you may be digesting it from there. Any which way, thanks for stopping by and for looking into this. So the topic this evening, and this is a half-hour session, it's a quick session, and I've got some slides to share. And it's around building your business plan for sale and for a 3-year exit strategy, if you like. And I'll give my thought process behind that. My name's Neil Bussey. I run a fractional business. So I'm an engineer by training, and I've been involved in executive management and running companies in the UK and overseas. And now I work in a fractional capacity, if you like. And what that means is I basically engage with clients, normally 2 to 3 days a month, and I help them to sort of overhaul their businesses and to prepare them for funding, prepare them for sale, or help them to professionalize their businesses at any point in the life cycle of the company. And that can be to do with building assets. It can be to do with building out strong cash flow and building out profitability as well. So it's a complete piece. And I think the fractional executive market is opening up now, and businesses are able to tap into sort of executive level skill sets and within people who they can't perhaps afford to bring into the business, or it doesn't make sense to bring into the business full time. So you can actually just pick and choose. There's a whole variety of people out there who offer professional services in a fractional capacity. So that's what I do. And like I said, within half an hour, I want to cover some information around building your business for sale, a 3-year plan. So we'll dive into that, and I'll walk you through some of my ideas here. So first of all, I'll start out with the problem itself. Why is there an issue around this, and how do I see that? Obviously, you've got two sides of the coin here. You've got sellers, you've got buyers, you've got an interaction which goes on, and there's a dynamic there which I think is very much in favour of buyers. And I'd like to help sellers to address that issue, but it involves sort of taking a step back and looking at it from a long range kind of time horizon, if you like, and rather than it sort of being thrust upon you. So this is really about sort of planning strategically for a sale in the long term. When you look at the market itself, this shows you the demographic of businesses by age in the UK. So these are government figures, and over a third of companies are between 1 and 4 years old on the register at Companies House. There's about 5.5 million companies registered, and then they drop off significantly as you get to 5 to 9 years, 10 to 14. So about 3/4 of all businesses are that's less than 10 years old. And once you get into the realms of sort of 20 years plus, you're really in the sort of the single figure percentages. So it's very high attrition within the business community, and it doesn't maybe seem evident day to day, but businesses come and they go, and businesses don't tend to grow old. A lot of them get sold, but they also get liquidated either voluntarily or compulsorily. So like I said, it's quite an attritional environment to operate in. And if you're going to sell, and you want to sell at a sort of best possible price, then that is a rarity. That's a kind of outlier situation. And what I do is help businesses to try and build longevity, so that they can buck this trend and buck this sort of depressing trend that there are very few businesses out there that sort of stand the test of time or go on to realize their full potential. So like I said, very attritional. 3 in 10 businesses make it to 10 years. 1 in 10 make it to 20 years. And the actual average age of a business in the UK is around 8.5 years. And that was in the early 2000s. It was more like 10 years to 10.5 years. So it's dropping as well. And you could say there's been a lot of new businesses launched post-COVID, and that is true. It is sort of a golden era, if you like, for launching a business. So there's a lot coming through, but that attrition rate remains very high. And so you end up with this, like I said, this kind of depressing curve that we would like to turn on its head if possible, or contribute to. In terms of sellers actually selling into in a market environment, what I see is buyers being far more experienced than sellers. So the deck is stacked against you as a seller, and that's because buyers tend to do this for a profession. So they're buying businesses on a regular basis. They know what they're looking for. They know which buttons to press. They know how the process works. They know that they hold the whip hand, and they know that the reasons why sellers tend to sell means that the timing is not always ideal for them, and there's urgency around what they're doing. And I think that there's insufficient forward planning on the part of sellers, which puts them into a difficult situation. So if you're insufficiently planned and you're walking into an engagement or a negotiation with another party that's more experienced in that, then that's going to be very difficult. And most sellers only ever sell once. It's something you build a business up, and that's your pride and joy, and you live out your career with that, and then you sell that business. But it means that selling environment is not something that sellers tend to be as experienced as buyers in, and that creates this distortion around where the authority sits and where the opportunity lies. What's the solution to that problem then? This is what I want to get into. And I think you have to really understand, first of all, about why buyers buy. And you could say that they're actually just simply buying cash flow. And of course, buying a cash flow in business can potentially be a good investment. But it's unlikely that you're just going to buy a business for the cash flow alone. If you have a sum of money that you can put somewhere, the likelihood that it's going to be within this particular business is very small. They could have any number of investments that they can make with that money. So just purely buying cash flow is rarely what buyers are looking for. They may be purchasing reputation and connections and expertise and other unique things, intellectual property that a particular business happens to have. But again, I think these are, maybe these are complementary things to the businesses that they want to, that they already have, and they see that opportunity. Because the reality is that businesses are bought and sold based on a perceived opportunity. They're based on not what they're worth today. They're normally based on a buyer seeing an opportunity to take it and do something with it that the current owners have not done, either a new market or a diversification or a level of complexity or something that the existing owners either can't do, won't do, or haven't noticed. Unfortunately, businesses are not valued based on perceived opportunity. They're based on the valuation of a business is normally based on what it's doing today, not what it could be doing in the future. And the difference between the two is the opportunity for the buyer, and it's where the seller tends to lose out. I'll give you an example of that. So Instagram, for example, and this is not a field that I play in, but it's one that everybody will be aware of. So Instagram was founded in 2010, and it was actually purchased by Facebook in 2012. So they barely had 3 years worth of trading data when they were purchased by Facebook. And at that time, there was $1 billion changed hands for that company. So that's 9 noughts there. And if you looked at the business and said, we're going to value this in a traditional fashion, there was no revenue in the business or negligible revenue in the business at the time. And the company was not profitable, had no significant earnings either. So for a business with no earnings and no revenue, for a company to pay $1 billion, they're not buying the business and what it represents today. What they're buying is a future opportunity, and they're seeing that, and that's what they're paying for. And in this case, they paid, not over the odds. It's perceived to be one of the great tech purchases of the current century, really. When you look at what Instagram has done for Facebook. And the reason they purchased it was things like user growth. They understood that the number of users, they had 30 million users when the company was purchased, and it was growing rapidly. So there was strong potential there for user acquisition. There was a focus on mobiles, and that was really where Facebook wanted to go. And the engagement on Instagram was very, very high. And Facebook realized that they could actually monetize that level of engagement. So there was a number of things which ticked the box for them. The strategic fit was good. They were moving into a mobile preference from working off a mobile platform. And that's changed so very quickly. Even in 2010, that wasn't as much as it is today. And the sort of photo sharing arena that Instagram was so strong in, and the future revenue potential in terms of integrating those clients into their own ecosystem was represented the opportunity which they took hold of. So it was an opportunity value that they saw in the company, not on what it was doing at the time. And unfortunately, that's not how businesses are generally valued. If you go to market and you meet with a broker and an accountant and you get people involved, they will value the business on what it's doing today. And we'll look at that in a moment. But that is where I think there's a missed opportunity. And you do, of course, have to get all your ducks in a row with a traditional valuation, which I can help with. So really, the lesson in that is that you sell the future. You don't sell the business itself as it is today. You sell the opportunity of what it can become in the future. And I think that's part of the job of the seller. If you leave those chips on the table, then you're missing a big opportunity. If you're just purely selling it on today's cash flow, on the last 3 years of earnings, and all the good stuff that you've done, then you're missing out on taking the buyer on a journey and actually creating some competition around various parties being interested in what the business could become. And you'd have to have a plausible reason why you want to step away from it and not convert that opportunity yourself, but actually let somebody else have it. So all those things need to line up. So why do sellers sell? And again, I think this is one of the reasons why the deck is stacked in the favor of buyers. It can be for personal reasons, it can be for health reasons, it can be for retirement, family disputes. I've seen family-owned businesses where they're passed on to relatives, and new management comes in within the company, and you end up in disputes, divorce, or even just stagnation and boredom from the current owners. And whilst these all seem perhaps depressing reasons why you want to step away from a business, they're all perfectly plausible, and they represent an opportunity for a buyer, because the buyer can see that they could acquire something that the owner is having to relinquish, which they wouldn't otherwise want to relinquish. And therein lies an opportunity. So it can be for these reasons. And why I think this is at the disadvantage to sellers is because these things can be thrust upon you, and therefore then the timing gets away from you, and you're in a position where you're having to make a decision in the short term. And that's where there's a risk of your business being plundered, and the value being plundered by somebody who sees the opportunity to take that off your hands at a fraction of what it's truly worth. Or it could be for legitimate business reasons. Sometimes a business is very successful and it grows so quickly that it outstrips the capabilities of the current ownership, and they don't have the appetite or the skill set or the stomach, if you like, to actually to take it on that journey. And so they'd rather just cash out, and they've had a good ride and they want to pass it on to somebody who's able to do that. That's a very valid reason, and that would represent a real massive opportunity for a buyer. On the flip side, it could be that there's problems with the business financially, or the company is perceiving that there's going to be a loss of competition or a loss of competitiveness within their business over the coming years, and they realize this is going to wane, and they're trying to get out at the top, if you like. So again, that should all come out of the due diligence exercise, and that would not be a good reason to be selling. So if that is the case, then you'd want to address that before you take it to market. So to address these things and to actually put the control back into the seller's hands, I think 3 years is a good time frame to actually play with. I think that takes you away from the urgency of the immediate sale and puts you in a position where you can be strategic and think about what you need to do in the lead-in. And I think this makes good sense to do at any time. If you want to run a successful business and you want it to be ready so that when something does happen, when some health scare happens or something unforeseen happens that you don't want to happen, or even changes in the market, which means that it necessitates the sale of the business, that it's in good shape to do so. So even if you don't plan a sale, I think these are important steps for a business to take to optimize itself. So let me have a look here. So the first one would be, how is a business valued? If we can understand this, then we can start building the steps into actually to maximize the valuation at the point of sale. And traditionally, the methods that are used are as follows. So you would have cash flow methods, so discounted cash flow, looking at the future potential earnings or cash flow of the business and discounting that back to current day. If you're an accountant, then you'll know this principle very well. For everybody else, this is the sort of methodology whereby you have the lottery has scratch cards, where if you win, maybe they'll give you $1 million today, or they'll give you $10,000 a month for the next 20 years, and you can decide whether you should actually take the $10,000 a month or take the $1 million right now. And what an accountant would do, what a valuer would do, would discount all those future incomes back to a present day valuation, and so that does take into account some sort of future potential of the business, or where you think the business might go in the future. If it's a very capital intensive company, so if it's manufacturing, you've got factories and you've got equipment and you've got fleets of vehicles and all that sort of stuff, and it's very intensive on capital, then an asset valuation may be a route to take. And the third one, and the top three here are really the most commonly used methods in my experience, would be the earnings method. So you look back at the last 3 years of accounts, and you look at the earnings of the company, and then you make necessary adjustments for any unusual discrepancies or spends, and actually get through to the root earnings of the business. and then there'll be some sort of multiple of earnings depending on what sector you're in. It might be 5 times your EBIT. You take out depreciation and amortization and how the business is financed, and just look at the profitability and say, well, it might be in this particular sector 4 times, 5 times EBIT, 6 times, whatever it may be, and that will form the basis of a valuation. So what that tells me is that it's important that cash flow is strong in a company. It's important that the business has assets. It's important that profitability and earnings is strong. If it's a publicly listed company, which I've not been involved in selling, but publicly listed companies can go on price to earnings ratio because they have shares that are available to buy, so the share price is public knowledge. Entry valuation is about working out what it would cost to create a business from scratch today and using that for the basis of a valuation. And the last point, comparable analysis. So this is looking at other companies that have sold recently in the same sector and using that as a benchmark to try and get an understanding of what that company might be worth. So these are the things that which a valuer would take the business through in terms of creating a desk study valuation. And like I said, the depressing thing with this is it doesn't take into account future opportunities. Maybe the discounted cash flow method does, but only if you actually lock in the value of future opportunities into your future cash flow. If you don't, and just imagine that it's just growing at some nominal rate, then you're failing to capture the value based on where you think there could be market opportunities for the company in the future. But these things need to be taken care of. It's irresponsible of me to suggest that you can just paint a picture for a buyer of a rosy picture of some time in the future where something's going to happen which hasn't happened so far. It's going to be rooted in desk studies around what the company's done to date as the first basis of evaluation. And so for me, that means that it's very important to get ahead of earnings, assets, and cash flow. And this is why I think you need a lead in before you start looking at engaging with brokers and talking about vetting buyers and looking at potential exits. Getting all your house in order on these things will take care of all the points that you'll touch upon in a due diligence exercise later on, and make sure that there's nothing which trips the business up or causes a drop in the valuation. And the way that I've done that in the past with companies that I've run and companies that I've worked with clients is to actually create an avatar, which is an exercise where you look at the sector and say, what would be a best-in-class business in this sector? Every sector has different dynamics in terms of the market, in terms of what potential there is for earnings, etc. Some companies, like I said, heavy on capital. Some are service-based industries. Some have a high margin. Some have low margins. It's all very much business specific. But it will be about creating a set of metrics. We got involved with this with a company in Australia that was manufacturing, and we said, what would be a best-in-class manufacturing company in this particular sector? And we then defined that. And these are not the figures for that company, but we defined a revenue. We defined what we thought the best possible gross margin that we could achieve. And these are evidence-based figures based on competition, based on what we know about the market and what we've achieved in the past. And so the top 3 components here, revenue, gross margin, operating profit, those are things which are relevant to any business. That company I'm referring to, it was manufacturing, so inventory turnover as a measure of efficiency was a relevant measure of efficiency for that business. That wouldn't be the case for, say, a service business or service industry business. So efficiency measures for building an avatar would be different sort of company by company. But effectively, you're building what is the best in class, what do we need to shoot for? And then you shoot for that. Then you give yourself a lead in time, and you start to identify where the gaps are between what your business is today and where it could be in the future. All the time thinking about building your assets, building your cash flow, building your profitability. That's what this is all about. And you end up getting into the guts of strategy and into the guts of execution. So how does the business make money? What are all of the things that it does uniquely well that are overlaid together, which make it very difficult for somebody else to come in and do that? And that's the basis of the strategy. And that'll involve competencies and unique skills and the brand and the network where the company operates and what IP they have. All these things intertwined that make it very difficult for the competitors to unpick that. And that's where the money's made. And then the execution piece on that. So what are the systems and processes in the business? How does the company recruit people? How does it train people? How does it invest profits back into R&D? How are sales executed, etc.? And there'll be gaps here. Some things will be done very well and some things won't be done nearly as well. And I tend to sit the company aside, an avatar, and then break it down into very minute detail in terms of discrete processes and systems and a representation of what does good look like? What is the company doing right now? And I end up with something like this, which doesn't present particularly well now. I'm looking at it on a small screen. the capabilities within a company. Because if you're going to get from where you are now to actually a good place where it's optimized, then you need capabilities in there. And these capabilities may be around recruitment, it may be around procurement, it may be around any number of things within the business. And those processes and the way that you go about things, the capabilities there, they may be ad hoc, they may be quite developed, they may be extremely developed, but I would be grading those in an analysis and actually looking at a capability diagnostic to work out where the gaps are, so that we can work on those, fill these gaps in, achieve that profit, achieve that those earnings and that cash flow before taking it to market. And what I end up with, and this is a recent client, it's sanitized, of course, but we've categorized things like cash management, what they do with procurement, sales and marketing, how they define their USP and their value creation, and graded those between sort of the initial low maturity level right up to sort of innovating. And the game is really to try and push everything as far to the right as possible. And this is what takes time. And this is part of the reason why I think 3 years is a realistic time frame to take a business, really optimize it, and really get the most out of it before you take it to market. So what I would be doing is proposing, in a certain phase, taking these certain components and moving them to the right with particular initiatives that we would embed in the company, and then go back and revisit, start moving the others, and shift all these things through a series of phases to get the business as developed as we possibly can. And that's quite a big exercise to sort of undertake. Now, that is really taking care of what will come out of a traditional valuation for the company later on. If I can take care of those things, and it's really all the nuts and bolts in the company about running an SME business in such a way that you optimize all those things. And that means that when it is valued and that valuation touches on cash flow, or it touches on earnings, or it touches on assets, that it will be maximized. But what I talked about at the start was having a plan to take the buyer on a journey where they understand what the opportunity is, because it may well be that there's a whole market that you haven't explored, that the business could expand internationally, or it could diversify into different areas, and there's things that are untapped. So I think the business has to be optimized. There has to be evidence that there's space to move into for a buyer, so that there's an opportunity for them to harness once they've got their hands on this business, and it's not completely the finished article, if you like, in terms of opportunity. And then the third thing and the final thing is the plausibility. There has to be a good reason why you want to exit, and you aren't planning to exploit the opportunity that you're putting before them. If that doesn't sit there, then the whole proposition isn't going to sit sort of very well with a buyer, because it doesn't seem to, it doesn't make sense, and they're going to potentially smell a rat there where there isn't one. So in terms of a strategic plan for outlining an opportunity and where the opportunity is, it may be that the business it has the potential to expand in the current sector in a way that builds some complexity or scale that the current seller can't do, or won't do, can't handle. And it's okay to say that. It's okay to say we've taken it as far as we can. We don't have experience, or we don't have access to certain markets, or we don't have particular IP. And then you can go to buyers who do have that, and the business represents more in their hands as an opportunity than it does in your own. So these are sort of plausible reasons why you may want to sell a company, even when there's an opportunity in front of it. It might be launching products and services into new markets. It might be overseas markets. It might be, again, areas where the business doesn't currently have access to those, or doesn't have the skills or the appetite to exploit those. Or it could be using the business's products and services to complement or enhance the current offerings in the buyer's portfolio. And that's a little bit like what Facebook did with Instagram. There was complementary things in there. They could use that. They could actually bring the Instagram users into their own ecosystem and exploit other opportunities. So again, that's a perfectly plausible reason for why you would want to sell a business, even when an opportunity existed. And in terms of the plausibility for exit, often with groups of owners or individual owners, if they're approaching retirement age and they want to increase the level of liquidity they have, they don't have the stomach for being an employee in a company they used to own, then they may want to get out altogether. And it's a life event really, that's meaning that they want to change their circumstances and actually come out of the business. I think that's perfectly plausible. And any personal circumstance change that fits the narrative, I think, is plausible. And actually, I think buyers do go for that. They do realize, okay, somebody's come to the end of the road here for whatever reason, and this is the opportunity. The business is still sound, but it's the person's personal circumstances that's changed. Or it might be that they want to launch a new venture into another field, and they just simply want funding to do that. Or it may be purely economic, and that does happen, that people want to change their lifestyle and they just want to sell out and they want to get the maximum possible price they can. whatever it may be, I think it needs to be put on the table. That can't be left unsaid. If it is left unsaid, I think it introduces uncertainty in the mind of a buyer, which will then erode the potential sell price. When what you really want to do is create a lot of trust and engagement, and with a good broker, you want to create some competition with a number of buyers who are looking to compete to acquire the business. So why 3 years? Well, I came up with 3 years. I think there's work to be done, like I said, on optimizing the business. If you're going to create an avatar and actually define what the best in class is for a company, and then you're going to go in and do a big capability analysis and work out where the gaps are and start looking at things like procurement and things like costings and manufacturing and efficiencies and recruitment, training, R&D, and all these other things, then that takes some time to do that properly. And I think, a lot of the 3 years is taken up with those sorts of activities before you actually get to the point of engaging with somebody who's going to help you sell a business. So these are my numbers. Now, you may agree or disagree with these, but in terms of doing that avatar exercise, doing a singular sort of one-off exercise and an assessment and doing some planning, there's a couple of months around sort of doing something like that. But then the real piece of work is then optimizing the business for that traditional valuation, which I've put 18 months on it. The longer the better, really. I mean, these are the sorts of things that you should be doing in your business all the time, not necessarily planning for funding or planning for sale. It could be at any point in the life cycle of the business where you just want to be best in class. You want to shoot for best in class, and who wouldn't want to do that? It's the top 5 or 10% of companies in any sector which enjoy all the spoils because they're at the pointy end of everything that's going on. Then there's preparing financial documentation and the actual valuation itself, which I put 3 months over. I think it's important not to rush the finding and screening the buyers and the actual negotiation, the due diligence, because I think as soon as that gets concertinaed up and squashed down, that is to the benefit of the buyer. That's not going to benefit the seller. So I think that the time needs to be taken in terms of screening buyers, of having that negotiation, of doing that due diligence, and then really closing out the sale. It's a month or two at the end, really, once all those other things have been done. I add that all up, that's 36 months. So hence why I sort of put a 3-year time frame around doing these exercises and getting a business together. And if you notice there, the first 23 months there, so the first 2 years effectively, is not actually talking to a buyer. It's doing all the other stuff first. And that's where I think this thing falls down. Circumstances change for people, and then they'll go to a broker and they want to sell a business within 3 months, 6 months, or 9 months, or something like that. Or they get approached and they get pressured and they feel there's an opportunity. When reality is that the first offer is never going to be the best offer, and it's probably best not to be pressured by buyers, but to go out and prepare properly and go to the open market with a view to getting a number of buyers interested in the whole process. So that was the 3 years that I came to. So the opportunity really is about taking a situation where you have very little room to move, and there's no opportunity value built into the value of the company as it's done now. And it's very much a traditional valuation. It's very much a buyer-controlled process, and actually introducing some competition into it, being prepared so that you can enter that situation where the due diligence is going to go well. That you've identified future opportunities for the business to move into. You have a great deal of plausibility around why you want to exit, and now you're able to start creating competition and interest with the right broker to be able to create that competition. It's more of a seller-controlled environment. Then the opportunity value is welded into the whole discussion, and ultimately the game is to maximize the highest possible price. Bearing in mind, people spend decades building businesses and their blood, sweat, and tears that goes into it. You don't want it to be plundered and all that value to be plundered because you're vulnerable, because you've entered into a situation without being properly prepared for it. Just my view, anyway. This is not what normally happens. If you follow this process, then you are an outlier. But I would applaud you for it. And hopefully, then it takes us away from this demographic picture and this picture of the attrition within businesses and businesses folding and businesses not being successful and not lasting the course and ultimately not exiting for the values that they've actually worked so hard to create. And it's more about fulfilling the potential of the company, whatever that may be. And an exercise of creating an avatar is a perfect way to actually sort of start unpicking that and thinking really carefully about what a business is actually capable of, and not just drifting along, but actually defining this strategically, putting numbers on it, evidencing the numbers, and then having a clear plan to move towards that. And as an engineer, this is obvious to me. I know it's probably a very structured way to work, and not everybody works in such a structured way. People maybe work in a much more intuitive way, but I think building a business is a very logical, process-driven, deliberate approach is invariably the best way to approach it. So in terms of what's next, like I said, I think these sorts of exercises are a good idea, whether you're looking to sell or whether you're looking to just simply optimize your business full stop. Whether you're looking for funding, there's various points in a business where owners tend to sort of look and say, okay, we need to get our house in order here. Whereas that should be, probably first point of business every day of the week, but it's not. The operational side gets in the way, and you sort of start thinking very tactically and not so strategically. And I've been in those situations with businesses that struggle with cash flow, and you are pinned down, and you're making lots of short-term decisions for this week, this month, this quarter. You're not thinking about the whole year. You're not thinking about 3 years, 5 years, exiting, getting all these things ready. But it's those outliers and those small percentage of companies who are successful long term that are doing these things, and that's why they're successful long term. And so, if you want to work with external fractional executives to achieve something like this, then certainly I can help on that front. If you want to look at creating an avatar, I've created other presentations and done other LinkedIn lives dedicated to how to create a business avatar. There's blogs on there that you can actually click through to, I think, on my profile. And it's the same with doing a capability or a diagnostic on the business to actually find the capability gaps as well. That is a whole piece of work on its own, and I've done separate presentations around that as well. So you can find those on my profile, or you can message me. I've got spreadsheets and other things I use to do analysis. So generic analysis tools. Happy to share those with anybody who's interested. But otherwise, I hope that was useful. I tried to put as much of my thought process into a half an hour as I possibly could around how to maximize your business, or the steps at least, without unpicking the whole process, the steps at least and the logic behind why it would take 3 years, and the dynamics that exist there, and how I think you can maybe start to stack those more in your favor. It's just gone 8:30. I did give it half an hour, and like I said, it's not a very interactive format, so I'll stop at that point. The last time I was here, I was talking to a broker, and it was an interview an interview format, and you can run and run. But with this, I've delivered the material, so I will leave that with you, and I shall let you get on with your day. Thanks very much.